What's up, guys? Welcome back. It's your friend Nate. I wanted to follow up with a question I got yesterday about ratios and how you can determine what return you're being offered at the current time for the investment that you're prospecting, right? So if you guys just go into Yahoo Finance or just Google your favorite company, let's look at the PE ratio, right? So what the price to earnings ratio is that, let's say the PE ratio is 10. Well, that means a couple things. It means that you're getting 10% on your investment because 1 divided into 10 is 10%, right? But also the conclusion is that the company's growth rate is going to be around 5% a year. So similarly, let's see if you look at another company with a significantly higher PE ratio, let's say if it's, 50 or so, the consensus is that it's going to grow at roughly 25% per year into the foreseeable future. And like I talked about before, you have to be careful with those conclusions, and you have to have a critical eye when you're really looking at this data. Do you agree with the current consensus or do you disagree? I find there is a level of optimism that really you can't get on board with. If you have companies that are 60, 70 price to earning ratios, you have to ask yourself, what would be the total market capitalization of this company 10 years from now if it were to really grow at 30% a year? Is that even realistic? And I would say that it's definitely not realistic and usually not worth the gamble. But again, with the ratio, you're finding out how many multiples of current earnings am I paying. My favorite ratio is the price to free cash flow ratio. Because when we say earnings, when you're talking about the income statement, of course there's things that are amortized, depreciated, and what you're really trying to find out is how much discretionary cash flow was it up to the company to spend. And so that's why I appreciate the price earnings ratio. It's definitely important. But over time, I've migrated to putting more weight on the price to free cash flow multiple because it's really telling you a more accurate number of the discretionary cash flow that the business chose to spend after the costs of operations. And like I said, that number is telling you, right? Imagine that all these companies out there are making you a proposition. Right? So if their PE ratio is 10, they're willing to pay you 10% on your money right now. Also, just likewise, you find a company with a 20% PE out there. That company is basically telling you, hey, we'll give you 5% on your money today, and we think it's going to grow at 10%, roughly, right? For the foreseeable future. The stock market is just a bunch of choices. It's just a bunch of investment choices. And, if you believe in the conclusion that the financials are presenting to you, maybe it's a good deal. But also, with a critical eye, if you were to disagree, then that's up to you as well. And just like the best investors have said, it's up to you. You don't have to make a choice. Stay with the things that you know. Stay with the things that you're comfortable with. You don't want to speculate to try to invest when you could just take your time, wait for a company that you're familiar with to experience some kind of issue that brings its current multiple down, bringing your returns simultaneously to the upside. So you're looking for either low multiples of free cash flow today, or if it's higher multiples of free cash, you're going to get a lower percent today on your money you're investing today. But the conclusion is that there'll be more growth there in the future with that cash flow. That's going to have to be based on your own conclusions, whether or not that result is possible or not. And that goes back to a previous video we did with the spectrum of speculation versus investing, right? You don't want to get carried away with unrealistic growth expectations.